Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. I'm Juliette Sarli. Great to have your company on this Tuesday and another down day for the market. Let's have a look at where the CBO 200 is finishing the session, off by about 0.6% ahead of tomorrow's all-important inflation data. The S&P ASX 200 falling to a similar level and is in fact at a 3-week low. We're still seeing these oil prices elevated. They're up for a 6th session. The US considering this proposal from Iran to reopen the crucial Strait of Hormuz, but we have seen quite a bit of weakness coming through, particularly in utilities and gold miners today, and certainly not the gains that you could have thought given the positive setup that we saw on Wall Street overnight, where once again traders just really shook off these concerns about what's happening in the Middle East and saw record highs before a raft of mega cap earnings out this week that's really going to test whether April's rally is sustainable. Here though on our market, really only the energy sector was doing well today, up by about 0.7%, but big falls coming through in consumer discretionary, utilities and IT as well. So this pessimistic positioning that we're seeing, and also a little bit of bullion bust with gold futures edging lower amid these attempts to restart US-Iran talks, which have been faltering. Central bank conundrum had a great discussion earlier with Paul Bloxham from HSBC. He says that the RBA, which is meeting next week, the RBNZ are in a very different position than other central banks in the world. Of course, we had the BOJ holding fire today, kicking off a very busy week for central banks. We've also got the ECB, of course, Canada. We've got the Fed as well in focus. So we'll get into more of that with Martin Crabb from Shaw and Partners coming up. But let's have a look at how some of the sectors fared today as well. I mentioned gold stocks coming under pressure, except you can see a little bit of upside there, but Newmont down by more than 4%, Northern Star and Evolution also under pressure. Utilities really got whacked. Origin was down another 4% to $11.62, and APA and AGL also weaker. And then when it came to that energy sector, that was the bright spot amid crude oil nudging back towards $110 a barrel. Well, Reliance Worldwide gained the most in 1.5 years as the company reaffirmed its outlook. Shares up by about 4.5% there. Domino's, though, it did not do well at all, down 10.5% after its US-listed namesake dived by around 9% on Wall Street following a disappointing first quarter that missed expectations. Origin there falling another about 4%, UBS downgrading both its price target and earnings forecast following somewhat of a disappointing trading update. European Lithium, though, absolutely soared. This is on an $835 million buyout from Critical Metals, or a bid, I should say. And Fletcher Building there finishing fairly flat. It is selling its Fletcher reinforcing and wire business to United Industries for $15.7 million. Well, let's welcome to the COB Martin Crabb from Shaw and Partners. Great to have you with us.
Good to be here.
Pretty tepid Tuesday, I would say then.
Tepid Tuesday. What happened to Taco Tuesday?
Well, not today.
Tepid Tuesday. Yeah, a bit of a disappointing. Obviously, the futures were down 60 odd points, so we thought we'd be a little bit weaker. But as you said, this is a big week for earnings in the US. There's 180 of the S&P 500 reporting, and all the big names, the Metas and Microsofts and all those sorts of stocks are reporting this week. And US reporting season has been amazingly strong, particularly in the technology sector. But it just seems that we rallied too hard off the lows. I think the ASX was at one stage 9% off its lows, but for the past 3 weeks we've just ground lower, haven't we? So today was an example of that. There was a couple of stocks that were up quite sharply on the open, and then people just sold them off, and people are rotating out of those, I suppose, sexier gold names into the lithium. So that's been one real standout in the market. Has just been the battery raw materials, if you want to use that collective term.
Yeah, well, there's a chart there. You're calling it Lithium Day.
Yeah, Lithium Day. So this is a US index, but it's the closest thing you've got to a proxy of lithium stocks globally. And you can see that that's been on a tear pretty much for 12 months. So that ETF listed in the US there, LIT, I think is the ticker for that. That's gone from almost $30 a share to almost 90. So it's been a three-bagger. So if you look at Pilbara, Liontown, MinRes, IGO, Linus. Linus is now like an $18 billion company. It's amazing. So people just pouring into those. So the derivative of the energy crisis is that it's boosting demand for EV even further. And so that lithium winter that we had is now very much over, and people are scrambling for product again. So spodumene prices are very strong. Everyone's upgrading. I think UBS upgraded lithium price deck overnight. So they saw upgrades to all their target prices. So we've been in that camp for a couple of months. Peter Cormandy, our analyst, has been saying similar things. And so the ones that we follow are also being upgraded. So that seems to be one area of the market. It's a little bit of a yo-yo, like it's a rooster 1 minute and feather dust to the next, that sector. It's getting back rooster mode, I think.
Oh, rooster's coming out for lithium. Now, I mentioned tomorrow's March CPI very much in focus ahead of the RBA next week. What are the rate expectations? What are the
so I think it's something like 80 bips for the month. But yeah, I think these monthly CPI readings, the market's still waiting for the quarterlies, right? So we're going to look at 4.1 or something like that for the CPI for March. And that'll be maybe 3.5 if we trim the mean, which is what the RBA looks to do. So for those viewers who don't know, the trim mean takes off the bottom and top 15% of movers. So it looks at the bits in the middle. So that's what the RBA like to look at. And we're starting to price in 3 hikes again. So cash rates are at 4.1. We've got a meeting next week. We've got another meeting in August. In between those is the June quarter CPI. And most people are saying that June quarter one is really going to reflect the full weight of higher fuel prices. And obviously that's spilling over into grocery prices, like in the papers it was talking about milk prices being up another 11% as well. So transport costs starting to translate across other areas. So you can see the market's now at 4.72. An economist we spoke to today said, look, don't be surprised if they have to hike 4 times, because they just need to break the back of this inflation and kill demand in the economy. And 4.6 are probably not going to do that for them. So that would be a pretty bad outcome for a lot of Aussie cyclical stocks. So we're starting to think about, portfolio positioning if the RBA have to hike more than twice.
And then do you fade the Aussie economy?
Yeah, I think you do. I think you definitely fade the economy. Within the market itself, there are lots of companies on the ASX that benefit from higher inflation. So classics are things like APA and Transurban. They have their tolls linked to inflation. There's obviously Viva Energy and Ampol, who, the refiner margins. You got Woodside and Santos. So big chunks of the market actually like inflation. Arguably, pricing power companies can pass on the higher costs. So if you're in a monopoly or an oligopoly, which is almost everyone in Australia, like all the banks and supermarkets are all operating in oligopolies or monopolies, they can pass on higher prices, so they don't mind them too much. But obviously other areas of the market that are more cyclical and competitive, things like construction. Like construction is so competitive, it's very difficult to pass on higher prices. So there'll be winners and losers out of this. So just, in Aussie dollar terms, the Aussie market's actually been outperforming over the past 6 months. We're just starting to see that unwind. So I think with the outlook for the RBA having to hike potentially more, great news for the Aussie dollar, but not so good for the share market. So we might see the ASX start to underperform the world index in Aussie dollar terms, which it started to do just recently. Get on with that a bit more.
Do you really think they are going to have to hike more than just May, though?
I hope that they don't. Well, definitely, they'll definitely, well, not definitely, can't be definitive. May and August look baked in.
Yeah.
I don't think there's much two-way around that. I think the June quarter CPI is going to be ugly. It's going to have a 5, maybe even a 6 handle, which would be ugly. It could be even higher than that. If the Straits of Hormuz don't close and we have fuel shortages, then we're going to see a bit of demand destruction, which will slow the economy, but it won't be enough to offset the inflation. So I think the RBA will be saying we're learning from our mistakes in the past. We weren't aggressive enough. The only bank really in the world that was aggressive enough was New Zealand, and they went really hard on rates, but a lot of other countries have got the same problem. So I think they might have to go a bit more than 2. I hope that they don't, because anyone with a mortgage is going to feel the pinch, because we're all floating rate. We just got to think about asset allocation if that happens, and stock selection with the Aussie market. As I said, there are some sectors of the market, like commodities, will actually like inflation. So there are places to hide, but from an asset allocation perspective, you might want to take some Aussie off the table and put in some global.
Well, this time next week we'll know, and you'll be with us after that May meeting.
Listening to Michelle's press conference.
Indeed. So we'll see you then, Martin. Thank you, as
Great.
always.
Thank you.
Martin Crabb from Shaw & Partners. Back to equities, the stock of the day was Reliance Worldwide, and we heard from Michael Wayne from Medallion Financial, Francisco de Stratis from Ord Minnett.
A business that hasn't really been growing the dividends greatly in recent years either. It's peaked probably 2 years ago, and it's been a pretty challenging 2 years. Obviously tariffs being one factor there, but also a fairly soft US housing market and construction market over there. And that housing recovery though is showing signs of bottoming and potentially picking up again, which will ultimately be beneficial for Reliance Worldwide. That's sort of what you're getting exposure to when you do buy this company. The business says they have no direct exposure to the Middle East conflict, and that certainly might be true in terms of the markets in which they operate, but you know, oil-driven input costs are significant when you think about resin, freight, energy costs, those kind of things.
We're a hold on the stock. It's trading on about 14, 15 times earnings, so it's not. It's probably fair value at these levels. If you look at that long-term chart that was up on the screen, you can see that it is a cyclical stock, so it goes through cycles. And you probably allude to that you're probably looking at the bottom of the cycle at the moment. When does that turn? I'd probably be a little bit patient.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN. Retirement income done differently.
All right, it was a down day, but let's try and find some winners today and kick it off with the stocks that did well, including Whitehaven Coal up 4.5%. And of course, we touched on Reliance Worldwide there as the stock of the day. Martin said it was a day for lithium, a lot of lithium love. You can see Liontown Resources there up by 4.4%. The laggards in today's session, of course, included Domino's after that disappointing update, which sent its US shares lower and the Aussie listed shares down 10.5%. A fair bit of weakness in some of the mining stocks, including those who gave us updates today, including West African Resources, Resolute Mining. In the small end of town, we had European Lithium with that very impressive near 50% jump. Elixir Energy there, a lot of the energy stocks, because that was pretty much the only sector that moved higher, while the laggards in the small end of town included Dimerix down almost 40%. Tonight, US first quarter earnings continue with Visa, Coca-Cola, Booking.com and BP. We also get the US Conference Board consumer confidence for April, which is expected to edge lower. Tomorrow, it's all about that inflation number for March, the trimmed and headline expected to move higher, pretty much baking in a rate hike for next week. And we also continue with the quarterly updates and hear from Woodside Energy, Ramelius Resources and Mineral Resources. So the COB 200 has finished the session down by 0.6%. The S&P ASX 200 has finished lower by 0.6% to 8,710 points. It's down around 2.7% over the last 5 days, unchanged though year to date when you look at the broader picture. But it certainly was, I think, something like a 3-week low that we have seen hit on the market today. US stocks, though, remain at all-time highs. We'll see what the Wall Street session brings with all those earnings in focus and bring it to you all from 9:45 a.m. Eastern tomorrow. See you then.